Welcome to this BDO International presentation, an introduction to IFRS 15, Revenue from Contracts with Customers. My name is Matt Tilling, and joining me today is Wayne Basford, IFRS Leader, Asia Pacific. Wayne, this standard is expected to impact on a range of companies and organisations. Who's most likely to be impacted?
Really, the slide says it all. So headlines: software companies, anybody bundling or licensing software, they will be impacted. Construction companies, looking at whether they should be on a point in time or over time revenue recognition, and much greater guidance in terms of how they recognise profit even within a long-term contract. Residential real estate, particular interest in Asia, Southeast Asia, as whether you sell apartments off the plan, whether you can get percentage of completion on that type of arrangement. Manufacturers are caught by repeat orders and modifications of existing contracts. Professional services, this is a control model and it doesn't fit that comfortably with selling services. So if you're selling an audit, if you're selling consultancy, if you're selling legal advice, should that be recognised again at a point of time when you're actually delivering a report, or should it be recognised over time? Licensors getting caught with whether the promise that you're going to deliver, whether it should be bundled with an ongoing service obligation. So again, whether a license can be recognised at a point in time or should be recognised over a period of time. And obviously the big picture is everybody that sells anything.
IFRS 15 is a comprehensive standard. It's titled Revenue from Contracts with Customers and replaces a range of standards and interpretations, including IS 18 Revenue, IS 11 Construction Contracts, IFRIC 13, IFRIC 15, IFRIC 18, and SIC 31. What are the headline issues?
The headline issues, it is complicated, and for everybody looking at this from an IFRS world, it is at the same standard now as US GAAP. Previously, US GAAP was very, very complicated in terms of revenue recognition. A key audit risk was revenue recognition. A key area of focus from the regulators was revenue recognition. A number of restatements have come about through incorrectly applying the revenue recognition principles in US GAAP. This has now moved into the IFRS world.
And with it, some significant changes in the revenue processes and systems.
The headline, chances are your revenue will change, not the total revenue in all cases, but the pattern of when you recognise revenue, and certainly the pattern of how you recognise profit. Processes, determining what the various promises are within your contracts with customers, and then deciding how prices should be allocated to those promises, and then deciding when those promises should be recognised will change processes. Capturing the right information in order to recognise revenue in the correct period will require extensive system changes.
I'd like to think about some of the specific examples of changes that you've identified. Can you take us through the first one? Mobilization and setup fees are not revenue?
In order for revenue to be recognised, a customer must have received a benefit. You mobilizing ready to provide that benefit does not represent a benefit to a customer, therefore you cannot recognise revenue.
Okay. Extended maintenance is a separate revenue stream?
So the headline is a lot of sales incentives that we previously recognised at cost actually represent a separate performance obligation, a separate promise to a customer. So if you've promised that you will maintain a car, service it, detail it over 3 years, well, that is not a cost of sale. It is actually a separate performance obligation to your customer.
And that's closely aligned with the next two issues. So major issues around having to bundle together certain performance obligations.
Yeah, so bundling, if you've promised to deliver goods and a service, or a bundle of goods or service, then it is to be viewed as one performance obligation. And the key headline here is on licenses. So if you've sold somebody a license, you've given them legal right to the license, but you've also agreed to host that license, you've also agreed to keep the license up to date, then the standalone license is not distinct in its own right. So the standalone license would be bundled with the ongoing maintenance, the ongoing hosting, the ongoing upgrades, and you recognize the whole bundle over time rather than at a point in time.
And conversely, we may also have issues with unbundling performance obligations.
Yes, unbundling it, and we touched on the extended maintenance examples on selling cars. Obviously there we're unbundling the promise to maintain the car for 3 years after delivery from the promise to deliver the vehicle.
Okay. Some other examples of the changes, and we've touched on the first effectively. A lot of sales incentives are going to be performance obligations, and so we'll need to recognise revenue where perhaps in the past we would just recognise an expense at cost.
Or you just ignore it completely. So in certain cases, for example, when you've given a follow-on bonus coupon, so I will give somebody a 20% discount on their next purchase, providing they actually are expected to make a margin of 50%, I would arguably just ignore the bonus, the coupon I'd given the customer.
I think one of the main headline issues has always been around construction contracts and the potential for changing the way the percentage of completion, or at least when the percentage of completion method is used. Can you talk to us quickly about that?
In terms of construction contracts full stop, there's obviously the question about bundling elements within the construction contract. The classic example on this is on design and build. Is it appropriate to separate the design costs and the design revenue from the build phase of the contract, or is it just one single promise? So if you've previously been recognising design revenue, it may push you to recognising a design and build and delaying margin. We've touched on previously that mobilisation is not going to be revenue, so in a number of construction contracts, mobilisation might be at the first stage of your percentage of completion. Equally, there's great guidance on, or a lot more guidance on, how you recognise components within your percentage of completion. The example given in the standard is somebody's refurbishing an apartment block. The first thing that constructor does is install lifts, install elevators. They're not a manufacturer of elevators, and therefore standard, the example goes on to say that no margin should be recognised on the installation of the elevators, but you can recognise revenue.
Related to this often, I think, is issues on recognising revenue when the asset is on the vendor's premises. This is often a construction issue, but now we're talking about things like ships and oil rigs.
And the key aspect here, in order to be able to recognise revenue over time, you must be satisfied that your good, the asset that you're delivering to your customer is distinct and has got no other purpose other than to deliver to that customer. And you also must be satisfied that you're entitled for payment of revenue based on the percentage of completion. And that payment term is not the same as the customer losing their deposit, and is not the same as the customer compensating you for lost revenue when you're looking at that contract. So it's a lot tighter rules on being able to recognise revenue over time, and it could well delay certain revenue or require changes in contracts.
The final dot point was controversial in the initial drafts and led to a lot of discussion, and there was a view at one stage that it wouldn't make it into the final standard, but it has. The idea of prepaid sales having a financing element. Can you talk us through that?
We're quite comfortable or used to the idea that if I sell sales on extended credit terms to a customer, then effectively the customer has borrowed from me and I should recognise interest income effectively from lending to a customer. In the same vein, if I've encouraged the customer to prepay and I've given effectively a discount for that prepayment because they have lent me money, it seems perfectly reasonable to treat that the customer has lent me money and therefore I've got an interest expense up until the period that the customer would normally advance funds to me.
But there is an expediency element to this.
The practicality of this is a very strong 12-month cut-off. So if the customer has only paid 11 months in advance, then there would be no need to go through the discounting, no need to recognise an interest expense and to gross up revenue.
These changes are going to change the pattern of revenue in the financial statements. As you said, it's not likely going to affect the absolute revenue figures, just the timing of the revenue figures. And this is likely to affect a number of elements of organisations.
Absolutely. And people just need to put their minds to how many contracts have I got that are dependent on profit in a particular period. And on the screen you can see bonuses, share payments, deferred payments, banking covenants. As the exercise to go through the entire implementation process, it will be to check which contracts are sensitive to it and to rewrite those contracts. Your employees will be very upset if they miss their bonus because the revenue under IFRS 15 has been delayed into another period. Equally, I don't think the shareholders will be that happy if you've paid a bonus only because revenue has been brought forward because of IFRS 15.
And also the tax authorities. There's some interest in how taxation authorities will view this new standard.
There needs to be a great deal of dialogue and communication with the tax authorities. I think up front, the tax authorities are most likely to stick to their current standards, so we will end up with different deferred tax balances, whether they be deferred tax liabilities or assets, that will also add to the complication of implementing this standard.
As we talked about earlier, IFRS 15 replaces a number of other standards, and I think this is quite a nice illustration of the difference between the new standard and the old standards. IFRS 15 itself, 39 pages in the standard. The existing IFRS and IFRS combined were less than or about 33 pages. 17 pages of application guidance, 2 pages of transition guidance, 26 pages of amendments to other standards, 82 pages of illustrative examples, and 175 pages explaining their basis for conclusion. This standard works out 3-4 times longer than all the previous guidance.
And it's a good standard. From a technical perspective, it is a good standard. There is a lot of guidance in there, either it be through the illustrative examples or the basis of conclusion. And it is going to cut down on judgment. So previous judgment, and there is inconsistent practice both applying IAS 18 and IAS 11, there will hopefully be far less inconsistencies in applying this standard.
If people would like to find out more about the standard, they can head over to the BDO International website, and on the IFRS working group page there's information about this standard, information about who to contact if they'd like to find out more information, and it's a place where we always put up information about new accounting standards. In the meantime, thank you for your time, and we look forward to talking to you more about this revenue standard in the future.